This question tests knowledge of regression analysis for cost estimation, a common quantitative technique used in management accounting and financial planning. Regression analysis helps estimate the relationship between costs, the dependent variable, and the factors that drive those costs, independent variables or cost drivers. It is widely used for forecasting, budgeting, and decision-making. The key phrase in the question is, simple regression differs from multiple regression. Students should remember that both simple and multiple regression have only one dependent variable, which is the variable being predicted, such as total cost. The difference lies in the number of independent variables used to explain that dependent variable. Simple regression examines the relationship between one dependent variable and one independent variable, while multiple regression examines the relationship between one dependent variable and two or more independent variables simultaneously. For example, simple regression, total maintenance cost depends only on machine hours. Multiple regression, total maintenance cost depends on machine hours, production volume, and machine age. One dependent variable, while multiple regression uses all available data to estimate the cost function. Incorrect. Both methods use one dependent variable. Multiple regression does not simply use all available data. It uses multiple explanatory variables. B. Dependent variables, while multiple regression can use both dependent and independent variables. Incorrect. Both simple and multiple regression always involve one dependent variable and one or more independent variables. C. One independent variable, while multiple regression uses more than one independent variable. Correct. This is the fundamental distinction. Simple regression uses one independent variable, whereas multiple regression incorporates multiple independent variables to improve the explanation of cost behavior. D. One dependent variable, while multiple regression uses more than one dependent variable. Incorrect. Standard multiple regression still has only one dependent variable. Correct answer. C. One independent variable, while multiple regression uses more than one independent variable. Exam tip. Simple regression, one dependent variable plus one independent variable. Multiple regression, one dependent variable plus two or more independent variables. The number of independent variables is what distinguishes the two methods. This question tests understanding of cost estimation techniques, specifically the use of regression analysis in management accounting. Companies often need to predict future costs by identifying cost drivers, which are factors that cause costs to change. In this case, the company wants to determine whether packages shipped, miles shipped, or pounds shipped can be used to estimate shipping costs. The key phrase is, determine if there is an independent variable that could be used to estimate shipping costs. Shipping cost is the dependent variable because it is the cost being predicted, while the three proposed cost drivers are independent variables. The appropriate quantitative technique should measure the relationship between shipping cost and these potential cost drivers and determine how well they explain cost behavior. Regression analysis is specifically designed for this purpose by estimating a mathematical relationship between variables and assessing the strength of that relationship. Flexible budgeting. Incorrect. Flexible budgeting adjusts budgeted costs for different activity levels after the cost behavior has already been identified. It is not used to determine which variable best explains shipping costs. B. Linear programming. Incorrect. Linear programming is an optimization technique used to allocate limited resources among competing activities. It does not estimate cost functions or identify cost drivers. C. Linear regression. Correct. Linear regression is used to estimate the relationship between a dependent variable, shipping cost, and one or more independent variables, packages, miles, or pounds shipped. It helps determine whether these variables provide reliable estimates of future shipping costs and identifies the strength of their relationships. D. Variable costing. Incorrect. Variable costing is an inventory costing method that includes only variable manufacturing costs in product cost. It is unrelated to estimating shipping costs using statistical analysis. Correct answer: C. Linear regression. Exam tip. Whenever a question asks you to predict a cost using one or more cost drivers, think of regression analysis. Dependent variable, the cost being estimated. Independent variables, the factors expected to explain or drive that cost. Linear regression, the standard quantitative tool for estimating cost behavior and forecasting future costs. This question tests knowledge of learning curve analysis, a quantitative technique widely used in management accounting, operations management, budgeting, and cost estimation. The learning curve concept is based on the observation that workers and organizations become more efficient as they gain experience performing the same task repeatedly. As cumulative production increases, employees improve their skills, processes become more streamlined, and the time and labor required per unit decline. The key phrase in the question is reductions in the time required to perform a task, as experience with that task increases. This directly describes the learning effect, where repetition leads to increased efficiency. Learning curve analysis is particularly useful for estimating labor costs, preparing budgets for new products, forecasting production schedules, and evaluating the impact of employee experience on productivity. Students should recognize that the question focuses on time reduction through accumulated experience, which is the defining characteristic of learning curve theory. A. Regression analysis. Incorrect. Regression analysis estimates the statistical relationship between a dependent variable and one or more independent variables. Although it is useful for forecasting costs and revenues, it is not specifically designed to analyze productivity improvements resulting from experience. B. Learning curve analysis. Correct. Learning curve analysis measures how labor time or production costs decline as cumulative output increases. It captures the efficiency gains that occur through repetition, training, and experience, making it the appropriate technique for analyzing reductions in task completion time. C. Sensitivity analysis. Incorrect. Sensitivity analysis examines how changes in assumptions affect outcomes, such as profits or project values. It does not measure learning effects over time. D. Normal probability analysis. Incorrect. Normal probability analysis deals with probability distributions and statistical inference, rather than improvements in productivity due to accumulated experience. Correct answer: B. Learning curve analysis. Exam tip. Remember the key principle of the learning curve. More experience, greater efficiency, less time per unit, lower labor cost per unit. Learning curve analysis is commonly used in manufacturing, aerospace, construction, and new product production, where repetitive tasks allow workers and processes to improve over time.